This is our Forex blog for April 18th, 2013. And while there are literally hundreds of different ways of trading using our tools and our software, I'd like to go over in our Forex blog one of the easiest ways. And these are our currency indexes: the dollar index, yen index, euro index, pound index. It just gives you a wealth of information, but most importantly, it lets you see what the trend is. You can see the Australian going up. It's having trouble right here getting above yesterday's high in the Australian dollar index. And so when it breaks down right here, it's very likely to continue its trend down, because you can see while the daily trend shifted up, it was down earlier in the day, the weekly trend is blood red. It's super weak. So you can draw trend lines on these. For instance, when this broke the trend line right here, that was really the beginning of the potential downtrend. It did make another wave up and couldn't break out and make higher highs. You have a beautiful double top right here. Great place to go short. And since I have all these indexes with the same color in there, I can push our demo trading button and scroll one of them back, and you can kind of get a feel for all of them. You can see the previous day's high in dotted green, previous day's low in dotted red. You can see the point of control in yellow. That's the price most traders have positions in for the previous day, and you can see it tells you how many pips up and down that went from the previous day from the day before. So yesterday the yen point of control went up 22 pips from the day before, so that's bullish. If it's above the hourly moving average in gray, above the yellow line, you want to look for buys. You can see the daily and weekly trend are somewhat up, but it failed, to go higher, and it went sideways for so long. One of our methods is basically looking for rectangle sideways consolidations, and when those break, you tend to get decent sized trends, and you can pretty much see that in almost every instance here. Every single time for 2 or 3 hours the market's stuck in a very sideways rectangle pattern, it tends to cause a trendable move when it breaks out. And underneath the hourly moving average, and you see one of these, you would prefer to go short. So when it breaks down right here, you're looking to sell the dollar at 2 o'clock. Which one was strong? Well, the Australian was working its way up. The New Zealand was above the hourly, above yesterday's point of control. The yen at 2 o'clock was trying to go up. This one was kind of just sideways. You probably would want to avoid that. At 2 o'clock, the CAD is just kind of chopping around here. So it wasn't really clear at 2 o'clock which trade to take. But you can, if the dollar's falling and another currency is just going sideways, you're going to make money selling the dollar versus that other currency. In a perfect world, when you see the dollar break down right here, you want to sell it versus a currency that's going up. So let's try to find some of these cases on the chart. We'll scroll through here and I'll show you some high probability trades. For one, when the dollar is above the hourly, you want to buy. When it's underneath it, you want to sell. The first time it comes back up and touches, that's usually a very high probability place to sell the dollar. At 3 o'clock right here, which one's the strongest? It looks like the Australian just went from below to above its hourly. It's above the point of control for the previous day. The New Zealand is as well, and the previous move was in the New Zealand was up. So between these two currencies, I would prefer the New Zealand because the daily trend's up, whereas at the time of the day the Australian is down and the weekly trend's weaker than this. So at 3 o'clock we're going to look for buys in the New Zealand dollar. And you can use tick charts, range charts, but I'm just going to use a 5-minute chart here for illustrative purposes. We're looking for buys coming up to 3. Here's 3 o'clock. This is in a nice little sideways rectangle pattern for 2 hours. And then it breaks out. And you can see it went from around 54 to about 65, 66. Not the biggest trade in the world, but you would go long right there. And typically I'll put my stop underneath the swing low. But if it's more than 10 pips, a lot of times I'll just put my stop underneath the breakout bar or 1 bar below. So the smaller your risk, the higher the odds of your trading success. Now, that's not always the case, because if you get stopped out with a ton of losses, and then you have small wins, you're not going to make money. But using our currency index, you're going to have a pretty high probability place. Now this is at 2 o'clock here. Actually, I was saying at 3 o'clock is when we should be looking at. This is a pullback to the hourly right here. The perfect oscillator is showing it's at an extreme. Usually when that hits minus 80, you're going to get a bounce of anywhere from 5 to 50 pips. And you can see it worked there, right here. Market kind of went up a little bit right here. Went up 15 pips right here. Went up 10 or 12 pips right here. Went up 15 to 20 pips. And you can also see at the highs, down, highs, down, highs, down. Now there are going to be 1 out of 7 to 1 out of 10 days where the perfect oscillator hit 80 and then the trend will continue. Most days, like today, the markets don't get in trend phase. They're just kind of oscillating up, down, up, down. Perfect oscillator is just an amazing way to trade the vast majority of the days. And I would prefer to be looking, if it's above the hourly, to be focused on the buys. And if it's underneath the hourly like this, focused on the sells. So in other words, you might not have taken this buy here, this buy here, or this buy, but you would have taken this sell here and this sell again later. And also when a currency is trending down, a lot of times it's not going to make its way up to this extreme high level. So what you can do is wait for it to get at or near the Bollinger Band on my tool, and then basically wait for a trendline break and then go short. If you see a market make a move up with a lot of intensity and then it comes real close to it the second time with much less intensity, that's kind of a divergence trade. Very high probability if you take those signals in the direction of the trend. In other words, if you see a buy signal and the trend's down, don't take them. But if the trend's down and you see a counter trend move up with less strength the second time, it's a no-brainer. Very high probability. So let's go look for some other trades using this. We'll scroll into the future. You can see the euro's in a little choppy range here. It came down to the hourly, tried to go up and failed. If it can go underneath that low, it's a pretty decent place to sell. You can see the daily trend of the euro is down, but the weekly trend's up. Some days are harder to trade than others. You would ideally want to trade a currency that's going up in real time. The daily trend's up, the weekly trend's up. And you can also use our currency meters, the FX trend intensity, to add to your probability. If you get a pullback and it doesn't show that much statistical strength on the move up, it's a higher probability trade. So let me go back and we're going to scroll through this and look for some trades here. You can see here the pound's underneath the hourly and broke from above to below the point of control. This is a very high probability support area, and you can see that yesterday the pound's point of control fell 12 pips. So traders are pretty much more net short yesterday than today, or than the previous day. Today it couldn't get above the resistance of the hourly moving average. So this is a very high probability trade right here when it starts to break down, a little bit after 4. So which currency is strongest? Well, unfortunately, it's clearly the Australian. However, its longer term trend is down, but the pound's also down. So it's a little bit riskier trade. You would ideally want to sell the pound versus a currency that's going up that has a daily and weekly trend that's up. Everyone knows you should trade with the trend, but the key is, and probably the reason why most traders lose money, is they don't know what time frame trend to trade off of. The real-time trend could be up, the daily trend could be down, or just shifted up. The weekly trend could be down. But you should just be aware of all the different time frame trends. I mean, the dollar's trending down today. However, its daily and weekly trend are still up. So keep that in mind. But let's take a look at selling the pound Australian at 4 o'clock, a little bit after 4. So so at 4 o'clock, you can see that the pound broke from above to below the hourly. It made a little move up right there. You probably would have gone short right here, or when it broke this, you put your stop right there, draw your fibs on this, and these are your fib targets. I will draw that on manually so you guys can get an idea. 4 o'clock. The key to trading really is, and this is where you would get short, put your stop a pip or two above that previous bar's high. This is what you're risking, and you have a good chance of making this A very high chance of making that, and if it goes to the next fib target, you have a good chance of making that. Take any trades that are, in this case, probably 70% likely to work, in my opinion, that have a good possibility of giving you 2 times or more what your risk is. My minimum win-to-loss ratio is 1.5. So if you're risking 6 pips, you only need to make 9 pips to, be successful. Also, watch our perfect oscillator. When you see it trending down and you see an extreme move right there, and it's at a fib target, probably 80% of the time it doesn't go past the 1.618 fib profit target, and we're also underneath our lower containment bands. So you take your trade. And for those who, a lot of traders don't understand the math behind Forex, 10 pips net per day doubles your account every 2 months. So taking a trade like this and making 20 to 30 pips is almost an entire week's, it's over half of a week's worth of minimum profit to double your account every 2 weeks. So keep that in mind. You're risking probably 6 to 12 pips on this, and you made 10, 20, 30 pips. We'll do one more example. And I like this Australian dollar here. When you get a double top and it finally goes underneath these lows right here, you want to sell it, because look how weak the weekly trend is. And so you'd want to kind of find a currency that's maybe super strong. The CAD went above yesterday's high. It's the only currency on the whole 8 that is above the previous day's high. So if the Australian can't break above the high and breaks down right here, and the CAD stays above the hourly, stays above its previous day's high, this would be a great trade. You would want to sell the Australian CAD whenever this breaks down. So we're going to watch it, assuming that this one's not breaking down too. Sometimes that happens. Alright, so right here, at this point, it looks like the CAD might be breaking down. The pound, unfortunately, has already been going up for 3 hours. So you got to be aware that it might find resistance at the previous day's high and pull back. But we'll take a shot at it. Looking at 9, we're going to sell the Australian CAD because we're hoping this is going to find support here. It did, and it was the only one that was above the previous day's high. It was quite strong. So we're going to look for Australian CAD trades to the downside at 9 o'clock. So let's take a look at this. 9 o'clock is right here. We're looking for sells. It's finding support at the hourly. When it comes up to and forms a double top right here, pretty decent place to sell. If you, for whatever reason, want to make sure it goes below the hourly first before getting in, you'd sell it there, maybe put your stop here. But either way you take the trade, you can see in the first instance, the one I would have taken, your risk is very tiny, less than 10 pips, and you're never going to catch every pip, but when it comes down here and kind of fails to go lower, notice it's at an extreme, so ahead of time it's very likely to reverse there. Notice again right here, went up, so you probably get out of some of your trade there. This is how much you made, and it appears that it's 4 times bigger profit than what your risk is, and it was very easily identified way back at 9 o'clock. If you got into a trade here, maybe you lost 8 pips, you got short again, you made 20 or so pips. I would have probably myself used a range or a tick chart, and I will end today's blog showing that. For ones I don't trade much or not familiar with, as far as trading like the euro dollar or euro yen and so forth, you can go to 4 pips per bar, and remember after 9 o'clock we're looking to sell this. And with a range chart you can kind of see 2 to 5 bars up, 1 bar down. You sell it when it goes 1 pip underneath that bar's low. This is how you keep your risk very low. Put your stop 1 or 2 pips above the high. And if you want to scalp this, you can get out of half your trade here, and then you're just kind of drawing a trend line over the bar's high, and you'd be out of the second half here at 60. You'd be out of half at 70, the other half at 60. That means your average price here is the exiting is at 65. This is how much you netted. This is what your risk is. And what's wonderful about this is it's 4 pips per bar. If the market's not moving, you don't get new bars. If every time the market moves 4 pips, there's a new bar. So you can just kind of move your stop down above the previous bar or the 2 bar back. If you see an up down pattern, that's oftentimes a reversal. In this case it didn't. This one right here didn't reverse either. Got a bunch of up down bars, and that was the end of the move.